Morning, how are you? If you didn't pick up the handouts on Monday, there are still a few copies in the back. You don't have to pick them up right now, but you can pick them up when you get a chance. A couple of very quick questions before we start. One is the first lecture note packet at the bookstore? Has anybody been able to buy it yet? Okay. There's only so much you can do with the bookstore. So, just print off if you're really intent on buying that packet in the bookstore, you'll probably have to wait till the end of the week. I'll put more. I called them on Monday. They said any moment now. Any moment now for them could be anywhere between now and the end of the semester. I'll call them again today, but as I said, the notes are online, so if you want to print off the copies and bring the 15, 20, we'll do about 20 slides pretty much in a session. So if you can bring the next 20 slides from whichever slide we did, we might go ahead and do 24 instead of 20, but you'll still be okay. But try to keep up with the class, at least in terms of the lecture notes. Second is a kind of bookkeeping question that I'm going to ask for the first 4 sessions, just to make sure people are staying on cue. Who's not in a group yet? Okay, kind of keep your hands up, just scan around the room. Maybe you can find a group right now and get the problem out of the way. Just keep your hands up. If you're not in a group, just put your hand up for just another minute so people can see how many people there are. Maybe one thing okay. I'll do 2 things. One is I will keep asking this question at the start of every class until it goes away. The second is I've started an orphan list for this class. An orphan list is for those people who cannot find a group. You just put your name on the orphan list and you hope and pray you'll get adopted. Okay? So if you feel you have no hope at all, you are unlovable, your self-esteem is hit zero, you just don't think anybody wants you, go into the orphan group. I guarantee you will get adopted in the next couple of weeks. Specify broadly what you know. So what I want to start actually with is that group project. I told you there were two aspects to the group project. One is this case that I will be giving you in about 4 or 5 weeks, which I can't give you because I haven't written it yet. And the case will not be a Harvard strategy case. It'll actually be a case that makes you kind of go through the grunt work of corporate finance. The second is the big project. So let me explain what this big project is. First, you work on it as a group. The group can be anywhere from 4 to 8 people, minimum of 4, maximum of 8. If you have 8 people in your group, just remember that the logistics of getting 8 people together gets increasingly difficult. So, every person in the group has to pick a company. So let me be clear. If you have 4 people in the group, there'll be 4 companies. If you have 8 people in the group, you'll have 8 companies. If you have 6 people, you'll have 6 companies. As you pick these companies, what you'll be doing is you'll be tracking these companies through the entire 15 weeks. And as I look at Disney and Baidu and Deutsche, you're going to be taking your company and doing exactly the same thing. In a perfect world, you'll be doing it in tandem. So when I do whatever I do this week on corporate governance, you'll start. So this session, I'm going to start on boards of directors and why they matter in corporate finance. If you can pick your, so you can see why I keep pushing you to pick a company quickly, because the quicker you pick it, the easier it is to follow along. But you could pick a random company for the first couple of weeks if you're still thinking about a company, and then catch up. Right? Here's the requirement for the group. The group has to be loosely tied together. The companies you pick have to have something tying them together. It doesn't have to be a specific, you don't have to pick 6 steel companies. In fact, please don't pick 6 big steel companies. It'll be incredibly boring, because this project is also about looking at differences across companies. So the more diversity you get in your companies, the more you'll be able to learn from this project. So I'll give you an example of a group theme. You could pick entertainment as your theme. You could have Time Warner in there. You could have Netflix. I mean, in a sense, you can think about the spectrum. You could even put Amazon in there and say Amazon is really in the entertainment business. I will cut you a lot of slack in your definition of entertainment. Some people get incredibly creative, perhaps overly creative. Just, this is not the place where I want you to spend all your creative instincts. I think, every semester at least one group will pick the Vice group. They'll have a casino company, so basically you can do that. I have no problem. What you will then essentially do over the course of this semester is essentially follow these companies. Here are some companies I would like you not to pick. 1, financial service companies. Why? Because they're incredibly boring. It's not because they're a challenge, but there's not much you can do. Think about it. If I give you a bank and say, how much can a bank borrow? Well, whatever the regulatory capital ratio allows you to do. How much can you pay in dividends? You got to ask the Fed. So I know that there is corporate finance that needs to be done at a bank, but if you really want to look at all of the dimensions of corporate finance, avoid financial service companies. Avoid money-losing companies, and again, the reason is very simple. Last session, remember we talked about Snap? How much can you borrow? Nothing. How much can you pay in dividends? Nothing. Capital structure and dividend policy get knocked off the top. If you really have an exciting money-losing company that you still want to focus on, come and talk to me. Maybe we can find a way in which you can bring it into the group and do something creative on those dimensions. Try to avoid companies with very big financing arms. There aren't that many, but it's good not to do GE. My vision of hell is it's like Groundhog Day, where every day I wake up and I have to re-look at GE day after day after day. So try to avoid companies with big financing arms. If it's a small financing arm, you can live with it. And don't do real estate investment trusts. Again, because there's not much to do. Real estate investment trusts, for those of you not familiar, were created in the early 70s. They can invest only in real estate. So already your investment decision is narrowed. They're not taxed, so you really shouldn't be borrowing. And they're required to pay out 95% of their earnings in dividends. So already you can see you're so constrained that there's not a whole lot you can do other than tweak the company. So other than that, you can pick, I think you have about 41,000 companies to pick from. I'll give you the entire list if you want. 42,668 was what I had at the start of this year. So you have lots of companies. Don't mean I can't find a company. You cut off every company I was thinking of. Well, there are other companies maybe you should be thinking about. So find a company as soon as you can. And of course, this will require some bouncing around the group. But the advantage is if you're the first one to pick a company, maybe you can drive the entire discussion. So that might be an advantage you might want to think about in terms of picking the company first. I won't go through the rest of this packet, but here's what it'll look like, because right now it'll make no sense. What it is each part of the class listed in terms of topics. There are, I think, 11 or 12 topics, starting with corporate governance, which is what we're going to do for the next 2 weeks, going on to hurdle rates and investment analysis. And with each topic, I've listed some questions. This is not a comprehensive list, so don't do Q&A. That's not what the project is about. It's about thinking through some of the answers to these questions and coming up with a narrative for your company. You know what I mean by narrative? At the end of the 15 weeks, if I came to you and said, tell me something about your company, tell me what it does well, tell me what it does badly, I want you to be able to, without using buzzwords or even numbers, explain to me what you think your company does well, what it does badly. Every company has strong points and weak points. Google might be a great company in terms of making money off its existing business. It's been an awful company in terms of finding ways to make money outside of online advertising. You say, maybe this is why. Apple might be a company that's got these cash cows going, but it's having a tough time finding the next project. It might not be borrowing the right amount. So think about your company as we go through this class. Think about the advantage of looking at it from the outside is you can be a lot more objective. Because you have no money at play, you're not working for the company, you're not consulting for the company, you're essentially thinking about the narrative for the company. So that's the point of the project, is by the end of, by May 8th, which is the last day of class, which is when the project is due at 5 p.m., you should have taken every aspect of this class and applied it to your company. And here's the nice thing, is once you've done this for one company, you can do it for 100 companies. And in fact, the best way to master corporate finance is to actually do this on company after company, because we can talk about abstractions. I can give you the equation for the cost of capital, just an equation. A computer can do it. What you will get by doing the project is you will start to put flesh on those equations, get a sense of what exactly you're trying to measure. Any questions on the group project? So basically, as you go along, and if you have intra-group issues, deal with them. There's no way. So don't come to me with this guy's never showing up. Find a way to kind of get people's attention. I'd suggest watching The Godfather. Great ideas. The guy's not listening to you, especially about horses' heads and the pillow. Hey, you don't have to go that far, but there are ways of getting people's attention. If it's a really extreme scenario, and there's usually 1 or 2 groups each semester where this happens, then I want to meet with you as a group and decide who you want to spin off. Split off, divest, whatever you want to use is the right term. Okay? We'll come to an amicable agreement, because I want this project to be a learning experience, not a stressful experience of dealing with intra-group dynamics. Okay? So that's a group project, and as I said, it starts right now. It actually started on Monday, but might as well officially get it started as of right now. So now let's turn to the topic at hand. So we're going to get into the first part of corporate finance. As I said, everything we do in this class is going to essentially mirror that big picture you saw. So for the next 3 sessions, we're going to talk about, hey, what are we trying to do in a business? What's the end game? What's the objective? If you don't know where you're going, it doesn't matter how you get there. If you don't specify a mission, an objective, then it's very difficult to think about how to do things right and how to do things wrong. So I'm going to start off by listing what in corporate finance we focus on objective. I'll give you why we do it. And then, as I said, I'm going to strip it apart and talk about all the weaknesses of what we focus on, look at alternatives, and then talk about why I come back to the classic objective function. So let's start with this notion of an objective. We're going to start off by saying the objective of a business should be to maximize its value. It's kind of fuzzy. What does that mean, value? Okay? Maximize the value of the business. Let me start to get a little specific about what we're talking about when we talk about the value of the business. I'm going to use the financial balance sheet I talked about last session. Remember that we have assets, you have assets in place and growth assets. On the other side, you have debt and equity. When I ask you to maximize the value of the business, I'm talking about maximizing the asset side of the balance sheet, the value of assets in place and growth assets. So think of what your mission is. If you're the CEO of a mature company, when I ask you to maximize value, you're looking at existing assets. How can I get more value from existing assets? If you're the CEO of Snap or Twitter, when I ask you to maximize value, it's the growth assets that you're focusing on because that's where the value comes from. So when we talk about maximizing the value of the business, we're talking about maximizing the value of assets in place and growth assets. The problem with that objective is it's blurry, first. And second, it's focusing on the entire firm. And here's a reality. If you're a manager or a CEO as a company, you answer to the shareholders, right? If you keep shareholders happy, you're going to keep your job. So in practice, what often tends to happen, instead of maximizing the value of the business, managers focus on maximizing the value of the equity. You might say, what's the difference? There are ways you can maximize the value of the equity while damaging the firm. We'll come back and talk about perverse ways you can do it. So in practice, you get this narrowing of the objective from maximizing the value of the business to maximizing value of equity. And here you run into a measurement problem. Who's going to measure the value of equity? You could call McKinsey or Goldman and say, value the equity for me. But that's going to be subjective and you're going to disagree with input. So in practice, here's what happens further. If you're a publicly traded company, you look for somebody else to estimate the value for equity. An unbiased estimate could be a screwed up estimate, but it's an unbiased estimate. So in practice, this gets narrowed even further to maximizing the stock price. So in traditional corporate finance textbooks, if you see the objective stated as maximizing the stock price, that's not true. It's really maximizing the value of the business, but we cheat. We go to maximizing value of equity, and then we use the stock price. And when we do that, we're making all kinds of assumptions along the way, right? Let's start with the first one. When I maximize stock price, and I tell you that I've also maximized the value of equity, what am I telling you about what I think about markets? They're efficient, that they do a good job of assessing the value of equity. When I say I'm maximizing the value of equity, and by doing that I'm maximizing the value of the business, I'm also telling you that lenders are protected. I can't rip them off. In other words, I can't steal from lenders and make my equity investors better off. But maximizing stock prices has become this mantra in corporate finance that drives how we think about decision making. It's going to get us into all kinds of trouble, so I'll tell you up front, but I'll tell you why it's become so embedded in corporate finance. The nice thing about stock prices is they're updated constantly. A company comes out and makes an announcement. Apple, after close of trading yesterday, came out with its earnings report, right? And after the earnings report came out at 4:15, you saw the Twitter feed kick in. If you get a chance, go watch the Twitter feed that comes out on Apple's earnings report. There are hundreds and hundreds of people posting. Some think it's good news, some think it's awful news, some think it's great news, some think it's... So you look at that, you could read those posts for the rest of your life, and at the end of the process, you're going to say, I have no idea what this is. 9:30 this morning, the stock opened for trading. You can talk about whatever you want, but the market opens, you get at least a collective judgment on what the market thought about this earnings report. You get instantaneous feedback on what you're doing. You announce an acquisition as a company. You paint it in the most positive terms you can. You talk about synergy, and you talk about the great things that are going to come out. But then you announce the market response, and it has a mind of its own. You might not like it, but that instantaneous feedback is something you cannot get with any other measurement device. Like what? If you say, my job is to maximize earnings, how often do earnings get updated at publicly traded companies? Once every quarter, we're a U.S. company, and outside the U.S., there are some parts of the world, they might be updated once every 6 months or once every year. Whatever other measure you pick, you're going to get this lag between when you act and when you can observe what happens. So the first sales pitch for stock prices is you get instantaneous response. If you add on top of that the assumption that markets, at least on average, are rational, we come back and contest this notion later, then the market price becomes as good an estimate for the value of equity as any other out there. And you get some great looking decisions. So if you make maximizing stock prices your end game, I can go through the game and say, this is how you should invest, this is how you should finance, this is how you should... you get this really neat way of tying things together. Now, at this stage, you're saying, why do I have to pick one objective? Why can't I have 5? This is the promise of stakeholder wealth maximization, one of the stupidest objective functions ever concocted. What does that mean? Well, I'm going to keep everybody happy. I'm going to maximize stockholder wealth and bondholder wealth and labor. And so, you can't do it. This is, I have 4 kids in my family. This is like going on vacation saying, my objective this vacation is to keep everybody really happy. You know what the end game is going to be? We're all going to be incredibly unhappy. I have to decide whose happiness counts, maximize that happiness, and treat the rest as constraints. We're coming up on a Super Bowl Sunday, right? The New England Patriots. 15 years of incredible success. Bill Belichick, right? At the start of every season. What do you think his objective is? Win, but is it to keep Tom Brady happy? No. Is it to keep the fans happy? No. Is it to make sure that his players like what he does? No. His end game is, I want to win the Super Bowl. Everything he does is driven by the end game. So he might actually lose game 15 and 16 if he feels it gives him a better chance of resting his players to win the Super Bowl. Does he want Tom Brady to be happy? Yes, to the extent that it helps him win the Super Bowl. Don't mistake constraints for objectives. Because there's a lot of dumping on stock price maximization as an objective. In my view, much of this dumping is unfair. Remember I said part of my job is to immunize you against some of the things you're going to hear about this? So let me take apart some of the things you will hear about why stock price maximization is so bad. You'll be told that if you maximize stock prices, that you can't take care of your employees. That this is a choice, but do you want to maximize stock prices or do you want to take care of your employees? I'm going to get rid of that presumption by giving you a few choices, and you tell me what you would do. If I gave you a choice right now of either working for Facebook or working for Twitter, where would you want to go? Without even knowing what the job is, I'm going to Facebook. You read that New York Times article talking about how terrible it was to work at Amazon? In fact, this lengthy article, how horrible it was. Today, if I gave you a choice, would you rather work at Amazon or would you rather work at Macy's? I don't exactly see the sign-up sheets for Macy's getting filled up the minute they get put up. If you want to take care of your employees, you first have to be a financially healthy company. And it really helps if your stock price is up 100%. Are there cases where you have to choose between what's good for the value of the firm and what's good for your employees? Yes. Is it painful that you have to, and you read stories like, part of the reason we make this link is we read news stories. AT&T lays off 20,000 employees, its stock price jumps 6%. Say, there? That must be the link. If you lay off employees, your stock price jumps. You got the sequence wrong. They had to lay off employees because something was wrong. The stock price jumped because finally you're saying you're out of denial, at least you're dealing with what's wrong. So this notion that if you go out and take care of earnings and cash flows and value, that you're not taking care of, I don't get it. In fact, if you get a chance, go to, Forbes has a list of the 100 best companies to work for. They make all kinds of subjective judgments. I'll wager if you took the 100 companies and you looked at stock price performance over the last 5 years, you're going to get a very high correlation. You know what the best company last year that they said to work for was? It was Google. You know what the worst company to work for last year was? They actually do a list of worst companies. Dish Network. You're probably calling from India saying, do you want Dish Network now? That's part. I think 80% of their employees now are calling from India saying, do you want to switch to Dish Network? It's a business that is unable to make money, and in a sense you see that reflected. You'll also be told that if you focus on maximizing stock price, that must mean that you don't care about your customers. How absurd is that? Again, take a list of the 10 best performing stocks. Then ask yourself, these stocks performing well because they don't care about their customers. If you have customers who are unhappy, they're going to stop buying your product. Again, don't take my word for it. Take a list of the 50 companies that did the best, 50 that did the worst, and ask yourself, which of these two groups has happier customers? It's going to be no contest. But here's the most unfair cut of all. You'll be told that if you maximize stock prices, that you're some kind of a moral pygmy, that you really don't care about the rest of the world, that you are in fact somebody who is going to violate every societal constraint and, in a sense, exploit society. In fact, I talked about other people's money last session. You can get a sense of how people think about corporate finance by watching that movie. Okay? I'll give you the story of the movie. As I said, Larry the Liquidator is in that movie, played by Danny DeVito. He's the bad guy. The good guy is this. In fact, in this story, what you see happening is Larry the Liquidator targets a New England firm that's been around 100 years for a hostile acquisition. And he's very open about this all through, that after he takes over the firm, he's going to shut it down. The New England firm is run by a founder, CEO, the CEO of the company, and the CEO is played by Gregory Peck. So you guys have seen Gregory Peck, right? Tall, distinguished. Danny DeVito, not tall, not distinguished. So basically you've got the corporate finance and the anti-corporate finance, at least the stereotypes. Danny DeVito is the corporate finance guy, and the CEO is the anti-corporate finance guy. He cares about society, he cares about his employees. What makes this movie different from the typical Hollywood movie where the bad guy loses and the good guy wins? This movie ends with an annual meeting. It's the most exciting annual meeting of all time. Okay? And in the annual meeting, Larry the Liquidator gets up. And in front of him are all the employees and the shareholders who want to stay with the existing CEO. He gets up and says, I know you're blaming me for shutting the company down. This company manufactured phone cables, physical cables. He said, I'm not the one who's shutting you down. It's fiber optics. Now you can blame me. I'm just the messenger here. And continue to do what you did, but you're going to essentially bleed to death over time. I'm just going to make this quick and painless for you, or painful for you, at least quick and painful rather than extended and painful. It's uncommon because you never see that presented, because it's easy to blame people for something that's happening. Again, if you think about corporate sustainability being socially responsible, to be socially responsible, you first have to be financially healthy. And I'll make this a personal story to bring this home. My oldest son, who's now 27, used to be one of the stingiest people on the face of the earth. He's the kind of kid who gave him a sandwich, he'd eat half of it, but then he'd lick it and throw it into the trash can rather than have somebody else get the other half. So this was around his 7th, 8th birthday. See, I'm not Roman Catholic, but I'm kind of a quasi-Catholic because I go with my wife to church. So I know when to kneel, when to stand up, when to do all this stuff. And so he has his First Communion. First Communion people come in with envelopes full of cash. I didn't know this was that lucrative. No. Otherwise I'd have said, can I have a First Communion too? No? So at the end of the First Communion, he collects all the cash. He has $300. He turns to me and he gives me $100. Like, go give this to the poor. As if I have some direct conduit to the poor, right? But I was flabbergasted. I said, Ryan, that's very generous of you. How come you're giving away so much money? He said, I'm rich now. And that, in a sense, cuts the core. If you're feeling rich as shareholders, your stock is up 100%, the company gets up and says, let's give away $100 million for this or that. You say, not a problem, I made so much money, you can give it away. If Twitter CEO Jack Dorsey got up and said, this year we're planning to give 10% of our revenues to charitable contributions. He's not making it out of that room alive because you're saying, my stock is down 80%, you're giving away money. If you want to take care of your customers, your employees and society, those are all noble objectives, but you're not going to be able to do that unless you build a financially healthy company. So to me, this has never been about either or. I think in the long term, if you want to build a valuable business, you need to take care of your employees. You need customers who like what you do. And you need to be viewed as a good social citizen. In fact, we'll talk about why it makes sense to follow those constraints of being a good good corporate citizen, because I think it adds to your value as a company. So we'll come back to these because this is going to lie under almost everything we do. But as I said, stock price maximization has become this focus in corporate finance, for better or worse. So I'm going to start off by listing the assumptions we need to make for stock price maximization to be the only objective you need as a company. In other words, what does the world have to look like for me to turn every CEO loose saying, all you need to focus on is increasing stock prices and everything's going to be okay? I'm going to call this the utopian world from which corporate finance is born. And already I'm giving you a sense of what I think about the assumptions I'm going to list, right? What's the essence of utopia? It never existed. So the assumptions I'm going to list are going to be patently unrealistic. I'm going to make them with a straight face, but I'm going to say every single one of these assumptions is an assumption that I probably disagree with and you probably will as well. So let's look at the assumptions you need for maximizing stock prices to be the only objective you need as a company. And I'm going to list the assumptions in terms of 4 linkages. The first is the linkage between stockholders and managers. Remember, in publicly traded companies, the owners of the company don't run the company. So if you own shares in IBM, you're not the one running the company, there are managers. So the first thing I want to talk about is the linkage between stockholders and managers. The second one I'm going to talk about is the linkage between lenders and the firm. You lend money to the firm, you have some assumptions you make about how the firm will be. So I'm going to talk about those assumptions. Then I'm going to talk about the linkage between the firm and financial markets, because after all, you run a publicly traded firm, you reveal information to the market, market assesses your price, what's that linkage look like? And finally, I want to talk about the linkage between the firm and society. So in the utopian world, this is the world where stock price maximization is the only objective you need. Here's what each linkage will look like. First, stockholders in this world have complete power over managers. They exercise that power through 2 mechanisms. One is through the annual meeting where they can hire and fire managers. And the second is through the board of directors. Remember, the original intent of having a board of directors was in publicly traded companies, they were the entities created to keep an eye on management to make sure that they were watching out for stockholder interests. Doesn't act that way, but that's the original intent. So in the utopian world, stockholders have complete power over managers. And managers are so terrified of what stockholders will do to them, they go out and maximize stock prices. So in the utopian world, that's what happens. In this utopian world, if you lend money to the firm, even if you don't protect yourself, you're not going to get ripped off. So you make loan agreements with holes in them as large as a Mack truck, the company doesn't take advantage of them. Why? Because they worry about reputation effects of having to come back to borrow from you. So I could give you all kinds of rationalizations, but in this world, if you lend money, company does exactly what it told it would do. It doesn't rip you off. Third, in this world, you reveal information to financial markets honestly and on time. So if something bad happens to you, you run out to markets right and say, guys, something horrible has happened, we just want to let you know. So I'll make this specific. I'm an Apple user, as I said last session. I've been an Apple user since 1981. For a long time, Apple did not have a laptop. In 92, they came out with their first laptop. It's called the PowerBook. It's only loosely a laptop. It weighed like 15 pounds, but it'll fit. You could put it on your lap and then fall over, right? But we were happy. Finally, we had a laptop we could call our own. It did have one small flaw. It sometimes caught fire. Now, spontaneous combustion is not exactly a feature you go looking for in a laptop, right? Can you imagine? Was it not? Oh, that one has it. It would make your next presentation incredibly memorable, but your next plane trip could be a disaster. So here's what Apple would do in the utopian world. They'd run out to markets the minute they found this out and say, our laptops are hot. Actually not. But you can see how companies often lie. It's the errors of omission. Technically, they're not lying, right? But when you hear that, you think they're selling a lot, not that they're going up in flames. So let me be very specific. In this world, they'd go out and say, our laptops are going up in flames. Or remember when the Apple Maps came out? And you'd have these horror stories of somebody who entered the local Dunkin' Donuts, ended up driving 4,255 miles, and complaining about it, to which you say, somebody this stupid deserves to be taken 4,000. Did you ever stop somewhere at mile 2,000 maybe and say, this is a really long way to go for a Dunkin' Donut? There were problems with Apple Maps when it first came out. And again, in this world that I just described, you'd go out there, our maps are not working, don't use them, use Google Maps instead. And in response, markets are rational and cool about the way they assess information. You know what a trading room would look like in this world? It'd be full of polite intellectuals. It's kind of a typical trading room, right? So when news come out, they get together at a table, they talk about expected cash flows for the next 10 years, they assess the risk, and maybe after they've done their homework, maybe a day later, 2 days later, say, okay, we should be buying now. And finally, in this world, there are no social costs. What's a social cost? It's basically any cost you create for society that cannot be traced and charged back to you. Now, part of saying only bad companies create social costs. You're already getting visions of tobacco companies. Oh, that's a typical social cost company. Every business creates social costs, including that hot dog stand outside. He's right in the middle of the sidewalk. Have you noticed? Every day when I walk down that sidewalk, I've got to walk 5 steps to the right, so basically it adds like 15 steps every day to mine. You're saying that's absurd. Think of the number of people walking down that sidewalk. Multiply by 15. That's a social cost. What I'm trying to say is every business creates social costs, but in the world that I've described, there are no social costs. Now think about why I need these assumptions. What am I trying to do? I'm trying to make the world safe for maximizing stock prices. In this world, the only way to maximize stock prices is to do it the old-fashioned way. Find an unmet need in the market, provide a product and service, produce that product and service, and make money off it. You can't make money, you can't increase stock prices by ripping off your bondholders. You can't increase stock prices by lying to financial markets. You cannot increase stock prices by creating social costs. Why? Because I've done what the classic economist does when faced with a problem. I've assumed them away. So here I can say, go out and maximize stock prices, and every company in the process of maximizing stock prices will make society better off and the economy better off. This is the utopian world that corporate finance was created in. I don't know about you, but I don't live in this world. The world that I live in looks a little bit like this. Every single assumption I've listed is going to go wrong. In fact, the question you should be asking is not what can go wrong, but what cannot go wrong. Let's start with the first linkage. What did I assume? Stockholders have complete power over managers, right? So if you don't like the way Jack Ma is running Alibaba, all you need to do is remove him. Well, good luck with that. Stockholders have little power over managers. Remember those 2 mechanisms I talked about, the annual meeting and the board of directors? I'm going to argue that each of those mechanisms is so flawed that it's very difficult. It's not impossible. It's very difficult for stockholders to exercise power over managers. So what do managers do? They put their interests often over stockholder interests. So we'll talk about times when what's good for managers might not be good for stockholders. So that's the first link that breaks down. If you lend money to a firm as a bondholder or a bank, and you don't protect yourself, you are going to get ripped off. It's not a question of whether, it's a question of when. You're saying, but what if I lend to a really reputable company? We're going to talk about the Nabisco story. And I'm going to introduce a word, if you're a lender. I'm going to call it being Nabiscoed. And from this point on, for the rest of the class, I'm going to talk about investors who get Nabiscoed. And you're going to see what I mean once I describe what happened in Nabisco. You lend money to a firm and you don't protect yourself, you are going to get ripped off. Do companies tell the truth? Do they tell it on time? Not in this universe, right? I'll be quite honest. I don't think most companies lie. They might hold back the truth. They might delay news. So there's a subset of companies, though, that cook the books. We find out about it 2 years later, 3 years later, 5 years later. And a big chunk of companies try to manage the news. You know what I mean by managing the news? They don't let you know right away when bad things happen. They try to bundle it. And markets are not angelic either. That trading room that I just described, full of polite intellectuals, let's make this a real trading room. Polite and intellectual will be the 2 words that don't come to mind when you look at that trading room. It's chaotic. It could be inefficient. Crazy things can happen. And finally, as I said, every company, every business, no matter how small or large, creates social costs. This is the world we operate in. Already you can see why if I ask companies to maximize stock price in this world, you're setting the seeds for those big scandals that you see, the accounting scandals, the environmental pollution scandals. The kinds of things come out of the fact that we live in a world where those assumptions don't hold. So let me start with the first of those linkages. In theory, stockholders have complete power. So if you look at how a corporate charter is designed, it is true. It looks like stockholders run the company through the annual meeting, through the board of directors. In practice, though, neither of those mechanisms really works at keeping managers in line. So let's start with the first one. How many of you are stockholders in publicly traded companies? Okay, that's quite a few. I'm amazed your savings haven't gone to zero yet. No. We'll figure it out. Over the next 2 years, Stern will make sure that you have no savings left. How many of you have been to an annual meeting? Not bad, actually. That's more than usual. You know that most people own shares in companies. I've never made it. Let's forget about most people. I own shares in about 50 companies, 53 to be exact. I have never been to an annual meeting, and I've never missed them. I mean, let me explain two reasons why. One is, I'm a stockholder in Coca-Cola. What does going to an annual meeting require me to do? First, it requires me to buy that round-trip ticket to Atlanta, right? This is a rip-off section of the airlines, which is, whatever reason, it's $600 round-trip. I have to get a hotel in downtown Atlanta. This is like being in a bomb zone. There's nobody there after 6 o'clock. Costs you $200 a night. By the time I'm all done, it's going to cost me $1,000, $1,200 to go to an annual meeting. There goes my profit for the year, right? For most of us, it makes little sense to go to an annual meeting. It's not because we don't care, but it doesn't make any economic sense. So what do we get? It used to be in the mail, but now we get it online, about 6 weeks before the annual meeting, that allows us to be at the meeting in absentia. As a stockholder in a company, what do you get about 6 weeks before the meeting? You get a proxy. What does it do? It allows you to vote on things that are going to be at the meeting without actually being at the meeting. It used to come in the mail until a few years ago, big fat envelope. And again, I'll make a confession. When that envelope landed on my desk, my only question was, trash or recycling? I didn't even open the envelope most of the time. And I'm not alone either. 40 to 45% of all proxies never get returned. Let me ask you a follow-up question. That proxy, I own 1,000 shares in Coca-Cola. When I throw it in the recycling, I'm a socially conscious being. What happens to those 1,000 votes that underlie my 1,000 shares? Does it go to the trash can with my proxy? Around the world, in much of the world, you know what happens to those votes? They get counted as votes for incumbent managers. Think about the analogy to a democracy. What percentage of US voters actually voted in the last election? We're not even talking about registered voters, adults who could have voted. Probably 49%. So in the world that I just created, what would happen? If you were the incumbent, you would start with the 51% who didn't show up. No incumbent would ever get defeated, right? You wouldn't even have to vote for yourself. This is a system that's tilted in favor of incumbents, and here's how it shows up. When you have that annual meeting and you have a contentious vote, I'll make it specific. Remember when Jamie Dimon pissed off a lot of shareholders about 3 years ago by becoming chairman of the board that he was of the board that was overlooking him as a CEO? He was recombining the CEO and chair job. About 3 years ago, so a lot of stockholders said, that's not right, you can't be overlooking yourself. And they brought this up to a proposal at the meeting, so people would vote at the meeting whether this was a good idea. Jamie Dimon won 65% to 35%. That's what was reported in the Wall Street Journal the next day. You know what I saw when I saw 65 to 35%? Basically, everybody who voted no, but you start with 65%, because a lot of people didn't vote. It is very difficult to get a no vote against incumbent managers at the annual meeting. We'll talk about how a Carl Icahn or a Bill Ackman tries to work within this tilted system, but it's a system tilted in favor of incumbent managers. So annual meetings are not that effective at keeping managers in line. And if that's true in the US, you should see what happens at annual meetings outside the US. In Japan, they actually hire people to get up and yell every time you talk at an annual meeting if it's something. I mean, this is, I remember an Asher Edelman, a hostile acquirer in the US, decided to try this in a Japanese company. So he goes to the annual meeting, flies out all the way to Tokyo, business class, I'm sure. Shows up at the annual meeting, gets up to contest managers, and as he gets up, this big group of people at the back all get up and yell at the top of their voices. Tries over and over and finally gives up. And if you go to Europe, they're exquisitely well-mannered annual meetings. They drink wine and they eat little appetizers. If your annual meeting is that well-mannered, nothing good is happening here. You can't ask any tough questions because it's viewed as impolite. I still remember a Wall Street Journal story about the Tattingers, which is the French champagne company, a publicly traded company. It's an annual meeting. And Claudia Tattinger was the CEO of the company. So one of the largest shareholders, an activist investor from the US, obviously an uncouth fellow, gets up and asks a question. He says, there are all these chateaus that Tattinger seems to be owning, that were shown as asset. Who's living in these chateaus? I thought that was a legitimate question. The company owns the chateaus. You'd like to know who's... She refused to answer the question. After the meeting, she talked to the Wall Street Journal. She said, I cannot believe somebody would be rude enough to ask such a question of me. It's like shares of Marie Antoinette and let them eat cake kind of thing, right? You almost want the guillotine to come out right there. Right? If you think annual meetings are tough places to contest managers in the US, they're even worse outside the US. That's the annual meeting. Let's move on to the board of directors. In theory, as I said, the board of directors is there. Oh, by the way, if you're working under the presumption that the Fidelities and the State Streets and the Janices of the world are going to bail you out by going to the annual meeting because they have lots of shares, dispense with that delusion. If you look at institutional investors' votes, they vote almost 95% of the time with incumbent managers. That's why when they shed crocodile tears about how passive investing is going to cause, nobody's going to ask questions, my response is, you weren't asking questions in the first place. So don't complain to me about Vanguard and index funds and ETFs, because if you'd been doing your job, maybe those funds wouldn't be doing what they are now, which is eating your lunch. Institutional investors are awful at why do you think that is? I mean, if you're Fidelity, you have 1 million shares in a company, you would think that you'd have an incentive if you didn't like the way management was run or something that to vote against it. Why do you think institutional investors are so quick to side with the incumbent managers? One is, how many companies does Fidelity own shares in? Hundreds, right? The way they see it is they don't have the resources to even do the kinds of research to contest managers. The second is there are all kinds of potential conflicts of interest you run into. The pension fund for this company, one of the choices might be Fidelity. I'm not saying that drives the decision, but whatever the reason, institutional investors, at least the traditional ones, are not going to be your allies if you think about contesting management. So annual meetings don't work that well. Let's turn to the board of directors. Let's start with some facts, and these are fairly unpleasant facts about directors. First, directors are paid well. Yeah, I don't have a problem with people being paid well. The average director in 2010, I don't have an updated number, I'll try to get an updated number, was paid $212,512. This is the S&P 500 company. So they're getting paid more than $200,000. And that doesn't even count the pensions and the other stuff they get. So they get paid a lot. They don't work very much. The number of hours they worked on average was about 228 hours. The good news is that's up from 120 about 4 years prior. So they're working more, so that's the good news. But you can work out per hour what you're paying directors to do. Third, much of that includes time like set up for the meeting, what they eat, the kind of schmoozing that you do at a meeting. So a lot of that time is not productive. And finally, lots of directors serve on multiple boards. This used to be even more common 5 years ago. You'd have somebody like Henry Kissinger on 15 boards, like Theranos. I wonder what Henry Kissinger actually does on your board? Does he go through your annual report, compute return on invested capital, and come and ask you tough questions about China? Or does he just come in and talk about the Iron Curtain and Russia? And I have no idea what he does. But there are a lot of people on boards you look at and say, what exactly do you guys do? You're saying, but Sarbanes-Oxley would have changed all of this. You know who Sarbanes-Oxley were, right? There, right after the 2002 scandals, this is the whole rewrite of corporate governance in the US, Sarbanes-Oxley. I'll give you my cynical view on what Sarbanes-Oxley has done. See that 228 hours? I think half the time it's directors meeting with lawyers asking, what do I need to do to not get sued? That's basically what Sarbanes-Oxley has become, a checkbox to make sure that you're meeting all the criteria so you don't get sued. It's a very cynical view, but boards of directors at most companies seem to view it as their job to protect management from shareholders, to be a shield, rather than somebody asking managers tough questions about the job they're doing. So I'm going to get specific. As I said, almost, so as we go through, I'm going to show you the board of directors for the companies I'm analyzing. I'm going to ask you, would you trust this board if you're a shareholder in the company? So the reality is that in most companies, still, if you look at, I will challenge you, pick the company you used to work for, pick the company you've invested in, open the annual report, go take a look at the list of people on the board of directors and ask yourself the question, who comes up with these names? They don't pick them randomly out of a phone book, right? Somebody comes up with the names, and in most companies, even if the CEO doesn't explicitly do it, I guarantee you that people are passing, that CEO either picks the person to sit on the board, or even if there's a committee that comes up with the name, a nominating committee, they pass it by the CEO. Let me ask you a question. You've just become CEO of a publicly traded company, and you're trying to put together a board of directors whose job it is to ask you tough questions, oversight board. Here are your two choices. You can go find the 15 most well-informed, intelligent people who know a lot about this business and put them on the board. They'll ask you lots of tough questions. They'll probably make your life difficult. Here's your second choice. You walk over to your local country club. You saunter over to the bar area. You look for the 15 most drunk people you can find. So would you like to be on my board? Which do you think is going to make your life easier? You're saying, that is so cynical. John Mack, when he became CEO of Morgan Stanley, the first two people he put on his board happened to be members of the country club he went to. I didn't check to see whether they hung out at the bar too much. But the reality is, this is human nature. If I let you pick the people who will oversee you, you're going to pick people who will not make life difficult for you. Second, in most companies, directors are required to have shares, but you know how they get the shares? The company gives them the shares. They don't even buy the shares. And you'd be surprised how many directors don't even own any shares still in many companies. They don't behave like equity investors. They behave like directors. And finally, there is this cross-listing phenomenon where you'll see an astonishing number of CEOs on boards. I don't know how you get the time to be a CEO of a company and a director in another company. And in some cases, you'll see people sitting on each other's boards. That's an interesting conflict of interest, right? So you're a CEO, I'm a CEO. I'm on your board, you're on my board. My board meeting is first. I'm presenting you my China project. It's not going well. You notice it's not going well. You're going to bring up the fact it's not going well. Then you remember your meeting is next week, and you have that Brazil project that's not going well, and I'll be at that meeting. It doesn't make sense to sit on each other's boards, but you see it. So let me start with why I think boards don't work the way they're supposed to. Because these are often bright people, they're successful in other walks of life. Why don't they do it? The first is, I still remember when my son was in the Boy Scouts, we had this guy who ran the Boy Scouts who was essentially a dictator of some sort. He'd call meetings and he'd bring this book, who the hell is this Robert guy and why does he write these rules? But they use his rules of order. Essentially, he would, every time he tried to bring up something, no, you can't do that now. It's amazing how you could keep unpleasant topics away from being discussed. So first is this rules of decorum, of how you run the meeting. Whoever sets the agenda basically decides what's going to happen at the meeting. Second, there is this need to be a team player. It's human nature. Once I put you on a group, it's so much easier being part of the group than being the skunk at the party, asking tough questions. And finally, there's a very interesting set of findings in behavioral finance. Because if you look at Sarbanes-Oxley, the big focus in Sarbanes-Oxley was we needed independent boards, right? That was one of the things they pushed for. That you shouldn't have boards where you had employees, that the board should be independent. And the idea was that if you create boards of independent people, they would stay independent, they would ask the CEO tough questions. But one of the interesting things that behavioral studies seem to find is if somebody in the room is viewed as an authority figure, after a while, even these independent people start looking up to the authority figure saying, if he or she says it, it must be true. You can already see why boards, as they're constructed, you're going to see the power shift towards the CEO. After all, he knows a lot more about the China project and the company than you do, or she does. Right? And you're going to feel a little wary about contesting a person that you think is the authority in this company. In fact, I'm going to make a suggestion that will never happen. But I told you I was a quasi-Catholic. There's a reason the Catholic Church has survived and grown for 2,000 years. There's much we can learn from it. Okay? In the 1400s, the Catholic Church had a problem. Too many people were becoming saints. Because here's what would happen. Somebody in some part of the world said, that person has to be a saint. A group of people would get together. They'd collect all the evidence. There's a whole lot of evidence you have to show, of miracles you've done. They'd show up in Rome. They'd present the evidence and just fly through. Do you know what the Catholic Church created as a counter? The most phenomenal creations of all time. It's called the devil's advocate. You know what the job of the devil's advocate is? When you push for a saint, my job, it's a very perverse job, is to prove that every miracle you claim is a miracle is not a miracle. So I'm given the resources, the same kind of resources you have to collect to prove that I'm given the resources to collect to prove it, this person's not a saint. See, what's this got to do with the board of directors? I'd like a devil's advocate. A counter CEO. Can you imagine? The CEO is at one end of the table, the counter CEO is the other. The CEO gets up and says, it'll be a good idea for us to acquire Twitter. The counter CEO gets up and says, it'll be a horrible idea to acquire Twitter. The CEO presents his evidence on why Twitter is a good acquisition. The counter CEO is given the resources to go out and do, he presents, you're saying nothing will get done? Maybe that's not such a bad thing. Too many, all I'm saying is in many companies, once a CEO gets something in his head that he or she wants to get done, it's almost impossible to stop it at most companies because the board of directors is not strong enough to get in the way. So as I said, everything we're going to do in the class is going to be applied. So I'm going to start with Disney. But I'm going to take you back to 1997. Why 1997? I am convinced that this is the worst board of directors ever created at a publicly traded company. Crossed out. That's quite a contest to win, right? Worse than the Enron board, worse than the Lehman board. This is the worst board of all time. So let me take you back to 1997. Disney was run by a guy called Michael Eisner. A guy whose ego was so large that he could be in a large room by himself, but it felt crowded. He's an imperial CEO. You know what an imperial CEO is? You do things and then you ask for permission. This is the board of directors he put together in 1997, in theory, to oversee it. So let me tell you what I don't like about the board. First, so I'm going to use baseball terminology. First strike against this board is there are 17 people on the board. You're saying, so what? I would like you to run an experiment after class today. I'd like you to get together as a group of 17 and decide to go where to go for lunch. I will predict that you will not eat lunch today. Because when you get 17 people around the table, the first thing you know that will happen is nothing. Because you go around the table, everybody talks, 3 hours are done, the meeting's over. So too big, strike one. 8 of the 17 members on this board are insiders. What does that mean? 6 of them actually work for Disney right now. 2 used to work for Disney. They're now on the board, and what's their job? To check managers to make sure they're doing the right thing. Clearly that's cutting against it. So strike 2. Who's chairman of the board? A guy called Michael Eisner. So this is what I took issue with Jamie Dimon for, right? Think about this, you're chairing the board that's supposed to look at you and ask the question, am I doing a good job? Okay? I think that's a potential conflict of interest there. That's 3 strikes. If this were baseball, you just struck out. Let me give them an additional strike. Then let's take a look at some of the outsiders on this board. Let's see if in fact maybe they're so good that they compensate for all the rest of the weaknesses. Let's start at the top. Reveda F. Bowers, principal of an elementary school in LA. They're saying, this is good. Disney is a kid-oriented company. It's good to have somebody who's around kids all the time. This might be sheer coincidence, but she happened to be the principal of the elementary school that Michael Eisner's kids went to. I'm sure it's pure coincidence. Okay. Let's keep going. George Mitchell, checking for steroids on the board. Father Leo O'Donovan, any Georgetown grads here? It's good to have some religious influence on this heathen board. But for better or worse again, and this might be sheer coincidence, Michael Eisner's son went to Georgetown. He happened to sit on Georgetown's board at the time, 1997, and he had made substantial contributions to Georgetown. I'm not suggesting there's any quid quo pro, but it doesn't pass the smell test, right? But here's the most egregious example of conflict of interest. Erwin E. Russell, attorney at law. You're asking, what do you have against lawyers? A lot, but this is not the forum for me to talk about that. This guy happened to be Michael Eisner's personal attorney. How do you get away with this? You put your lawyer on the board and say, he's going to be an independent third person, right? It's nice to have your lawyer in the room all the time. He's probably saying, don't answer that question, Mike. Take the 5th on that one, Mike. Okay? But don't tell me he's going to give you independent advice. And let me close the loop by looking at Sidney Poitier, great actor. In fact, he made the top 10 list of directors in 1997. He said, finally, somebody who we can count on. He made the top 10 list of directors who didn't make meetings. He missed 75% of the meetings in the previous 3 years. So guess who's coming to dinner guess who's not coming to the meeting this time? So this is the board of directors in 97, and this board is supposedly keeping an eye on Michael Eisner. There's no way that this board is going to say no matter what Eisner decides to do. Corporate governance has consequences. There were things that happened in the 90s at Disney, but people looked at, so why is that happening? How come the board's not acting? I'll give you one example. When Eisner came over to Disney from Paramount, when Eisner came over to Disney, Disney was a failing company in the mid-80s. Because Walt Disney had died, there was nobody to kind of step in and fill the void. They were producing one animated movie. The last hit was Fox and the Hounds from the 1970s. The company had lost direction. So they asked Eisner to come over. He was very reluctant to leave what was then a successful company, Paramount, and come to Disney. So as a negotiating tool, he said, look, I'll come to Disney, but I want to bring my personal assistant with me when I come. He said, personal assistant, who cares? Remember the days before iPhones, your personal assistant in Hollywood probably ran your life, told you where you lived, what your wife's name was, when her birthday was. He said, without my personal assistant, I'm lost. And Disney agreed, not a problem. The personal assistant, though, didn't want to come. His name was Jeffrey Katzenberg. To encourage him to come, Eisner said, if you come with me, I'll give you a division to run. He said, okay, personal assistant, divisional head, this looks like a leap up for me. I'll come. And true to Eisner's instincts, what he decided to do was pick the division that he thought was most likely to fail at Disney and put Katzenberg at the top. At that time, the division that looked most likely to fail was animated movies. Nobody's watching animated movies anymore. You can run the animated movie business. In fact, I think so little of this business that not only can you run it, but I promise you 5% of the profits on any movie you make in perpetuity. The rest, as they say, is cultural history, right? You got The Little Mermaid. Can you imagine collecting 5% of the profits on The Little Mermaid every time Ariel sings? You think, let's go. It's $25 in my pocket. No? See which comes out. You're just delirious. This is exactly what you want. Right? So over the next 6 years, Katzenberg converted Disney animated movies from this division on the verge of disaster to a division that accounted for 40% of the profits at Disney. Let me ask you a question. If this were a business management book, you've hired a guy to turn around a division, he's turned it around. If this were a fair world, what would you do to that person? You'd give him more responsibility because he's done so well. That thought never even crossed Eisner's mind. His reaction was, I have to get rid of this guy. Why? Imperial Caesars are afraid of people who might contest their power. So he went to the board of directors and I want to fire the guy. Imagine, you're the board of directors. I'm trying to fire the most successful divisional head in the company. I would assume you'd have some big questions. They said, how quickly do you need to do this? Right away. Then one of the board members does bring up this unpleasant fact that you promised him 5% of the profits on Little Mermaid and Lion King in perpetuity. You said, Eisner says, don't pay him. On what basis? I don't like him. They fire him, refuse to pay him. He, of course, goes to court. Case doesn't last very long. The judge says, on what basis are you refusing to pay Mr. Katzenberg? I don't like him. Sorry, that's not a contractual reason you can give for not paying. Pay him $150 million, which is what they had to do, which he used as seed money to create DreamWorks. Now do you see all those Shrek movies? Have you noticed in the Shrek movies what they do to Disney characters? Sleeping Beauty has an addiction problem. Snow White hangs out with 7 perverts. It's blow after blow. There is a history here. And Shrek delivers. So go back and watch all the Shrek movies. Say, there's Katzenberg getting his little digs in, right? But if you think about why it happened, it's because the board was not strong enough to step in and stop Eisner from doing it. When you have weak boards, the CEO essentially overreaches. And CEOs are human beings. So what effectively happens is even if you're a really good CEO, you have your weak side, right? If your board doesn't stop you, that weak side over time. When Eisner came into Disney, he did a lot of good things at Disney. He was an incredibly successful CEO, but the more successful he got, the more his head grew, the more his weak side started to dominate, and eventually it almost destroyed Disney as a company. So in 1997, CalPERS, which is the California Pension Fund, which was one of the first institutional investors to be activists, ask tough questions of managers. They actually on their website used to publish the list of the 10 worst companies in America, and then they would act on them. They would contest the manager, they'd ask them to try to change. In 97, they had 3 questions they would look at a board. They say, are a majority of the directors outside directors? Is the chairman independent of the board and not the CEO? And are the compensation and audit committees of this company entirely composed of outsiders? Disney was the only company that failed all 3 tests. So in 97, CalPERS viewed it as the worst board. Let me pile on. In Business Week in 97, ranked boards of directors for 500 companies from worst to best. There are the 10 worst boards. Guess who's on top? Disney. You're winning contests you shouldn't even be entering in. And you're winning them by miles. You're by far the worst board. Before you conclude that this is a Disney problem, this is a general problem. So once you pick your company, I would like you to try this. And this is more subjective. There are going to be no numbers, at least initially. Take a look at who's on the board of directors, and I'll send you some links on how to do research on connections. Okay? So you can start to see how independent a board can be. Increasingly, there are services that try to measure what are called corporate governance scores. Okay? They give you a number for a company. The higher the number, the better the corporate governance. Take them with a grain of salt, because many of them are based on check boxes. So basically, are your directors independent? So basically go through. So a lot of boards rank very high in terms of corporate governance, but they fail a much more fundamental corporate governance test, because to me, the essence of corporate governance is you have somebody pushing back against managers. So what I look for when I look at a company, show me some tangible evidence. Don't just show me the score. Show me some tangible evidence where the board has actually stopped the managers from doing something that they actually wanted to do. That, to me, is at the core of corporate governance. Now let's look at what happens next. You have a board of directors that's not doing its job. Not doing its job in what sense? Not overseeing managers. Managers are no longer afraid of shareholders. What are you going to do to them? Vote against them at an annual meeting? That's not going to happen. They control the proxies. The board's not stopping them. When they have to make choices, managers are going to put their interests over shareholder interests. So let me give you some examples. Let's start at the top. Green mail. You know what green mail is? Just like blackmail, just a lot more money and it's legal. So here's how it works. You're a company that's badly run. I am a hostile acquirer. I acquired 10% of your shares. And remember, in the US, once you get past the threshold, I think it's 5%, you have to announce your intentions as to what you plan to do. Do you plan to take over the company or just hold these shares? I call a big meeting or a journalist meeting, and I say, oh, get on CNBC, even better. And I say, I plan to not just take over the company, but take over the company and change it. Now, this terrifies you, right? You're the manager of this company. And the very essence of the word hostile means after I take over the company, I'm going to fire you. So what are you looking at? You're looking at two choices. One is I might be offering 25% more than the current stock price to try to acquire a company. You can open your corporate finance book which says maximize stockholder wealth. And this looks like it's increasing stockholder wealth. And say, you know what? We should just fold. Or you can say, well, I want to make sure I don't lose my job, so I'm going to fight this. Now be honest. Given a choice between this abstraction of maximizing stockholder wealth and protecting your job, most of us would try to protect your jobs. So here's what you do. You come back to me. Let's say I spend $100 million acquiring this 10% of the shares that I have in your company. You offer me $250 million to go away. And if I decide to go along with this, you make me sign an agreement called a standstill agreement, which means I don't... See, if you just pay me $250 and you don't get me to sign the agreement, you're in big trouble because I'll collect your $250 million. And tomorrow, what am I going to do? I'm going to buy... This is like being blackmailed repeatedly. So at least this system has some structure. So I collect your $250 million and I go away. You say, what's wrong with this? Where do you come up with the $250 million as managers? You should have sold your houses and your cars and your personal portfolios because you're protecting your jobs, right? Instead, what do? You take shareholder money and you use it to make sure that they don't get 25% more than the current stock price. That's a tough thing to explain away. That's green mail. Why does it happen? Because managerial, if you're not afraid of stockholders, you're going to be willing to do that. Green mail is legal in some states in the US, not legal. It's not legal anymore in Delaware, I think. I have to check, which is pretty much, it's this tiny little state, 330 companies are in there. But in the early 80s, when it was legal, companies would use this as a way of escaping from hostile acquisitions. Let's talk about golden parachutes. There's one thing about M&A, is its strange mix of medieval times and James Bond movies. People come on white horses with, golden parachutes. And they deliver all kinds of things to you. But I guess that's the nature of the process. There's a lot of strange mixing together of metaphors. You know what a golden parachute is? You're a manager of a company. You're worried that I'm going to take you over, a hostile acquisition. You're worried about losing your job. So you go to your lawyers after I've announced an acquisition, and you put in clauses into your compensation contract that says, if I do a hostile acquisition of your company, I have to pay you $5 million, $10 million, $15 million. You're protecting yourself. You're saying, what do my shareholders lose? Collectively, what I pay you as managers has to come out of what I'd have paid the shareholders. Again, your interests are dominating shareholder interests. And I don't blame you. Self-interest, right? So you're doing it because you're not afraid of what I will do to you. Poison pills. Poison pill, I'll give you a classic example of a poison pill. You know what a rights plan is? You know how it works in a company? Let's say you're all shareholders in a company. Stock price right now is $10 per share. In a rights plan, I give each of you the right to buy an additional share in the company at $5. The fact that it's lower than the price doesn't hurt you, because if everybody exercises the right, I collect the cash, You have 2 shares now for $15, but since everybody did it, nobody's worse off, nobody's better off. That's a classic rights plan. It's in fact a more efficient way of raising new equity than going out and issuing new shares at the current price and hiring an investment banker to underwrite it. European companies do a lot of rights issues. US companies don't do it because they're afraid of the bogeyman. You know what the bogeyman is for US companies? It's called dilution. So anytime you talk about rights, oh my God, there's dilution. But let's say that I devise a rights plan, $10 per share, and I give you the right to buy an additional share in the company for $100. You're saying, that's absurd. Why would I want that right? As long as I run the company. If there is a hostile acquisition, the minute there's a switch in control, the rights price drops from $100 to $1. You see what I've created? A security that's completely benign as long as I run the company. The minute there's a hostile takeover, it blows up in the acquirer's faces. So it kind of keeps them from doing the hostile acquisition. That's a classic poison pill. But I have a much better way of thinking about poison pills. It came to me when my daughter was about maybe 5 or 6. She's third in line to the throne. There is no throne, but whatever, whatever. So she's surrounded by brothers. She's 2 older brothers, one. At that time, the younger brother had not shown up yet. So we go for breakfast. I take my 2 older boys and my daughter to breakfast. We pull into the diner. We find one of those booths. I sit on one side. All 3 of them sit on the other side. Nobody wants to sit but Dad. Fine. My daughter's sitting in the middle. We have 2 older brothers on either side of it. They all order eggs with fries. The waitress comes in with eggs with fries, it's in front of each of them. The minute the plate lands in front of my daughter, she spits all over her fries. Disgusting, right? But if you have siblings, you know exactly what she was doing. Okay? You have fries on your plate, you have 2 older siblings on either side of you, know exactly where the fries are going, and they're not going in your mouth. She was introducing a poison pill. You see why it's a poison pill? You spit on your fries, you're okay with your own spit. You say, I'm not touching those fries. That's what managers are doing with poison pills. They're spitting on their fries. The only problem is they didn't pay for the fries. You and I, shareholders, did. So the next time you read about a poison pill thing, spitting on your fries, you kind of get the idea. Again, managerial instincts winning out over stockholder instincts. And finally, the final 2 I've actually put at the bottom, because these need shareholder approval. The first are what are called shark repellents. These are things you put into the corporate charter that make it more difficult to take over your company. I'll give you one example. Generally speaking, what percentage of the shares in a company do you need to take over to gain control of a company? 51%. When AT&T tried to buy NCR raised the threshold to 80%. So you couldn't change the board of directors of the company without it. You can do it. It's a corporate charter. Staggered board. So basically, instead of having the board be re-elected every 3 years, only 1/3. So basically, what it means is if you want to take control of the company, you have to wait longer. These are shark repellents. And finally, if your objective is to make your shareholders poorer in a hurry, I'm not saying that should be your objective, but if you say, look, you wake up one day and say, I want to knock off 30% of my shareholder wealth. The easiest way to do it is go do a big acquisition and overpay. So I'm going to at least set up this process. Overpaying on acquisitions, one thing we're going to talk about is investment analysis. And we're going to talk about projects, right? So with Disney, when we talk about a project, what are we talking about? We're talking about the next movie or the expansion of a theme park. And so we spend a lot of time on project analysis, and companies spend hours, days on a $50 million project, making you jump through all kinds of hoops. Did it pass this test? Then they do a $5 billion acquisition, and all the rules seem to go out of the door. I'm going to argue that an acquisition is just a gigantic project. With project, we're going to talk about a concept of net present value. So a good project is one that creates value. Net present value is positively creating value. If you take a project with a negative net present value, you're actually reducing the value of your company. Overpaying on acquisitions is like taking a gigantic negative net present value project. More wealth is destroyed in companies through big acquisitions than any other corporate action industry. And I'll try to back that up, because it's really difficult to knock off $20 billion of your shareholder wealth with small projects. All you need to do is do one big acquisition. So we're going to talk about what it is that drives this, but the evidence on acquisitions in general is a pretty depressing one. First, on the announcement date, there are two players, right? There's an acquirer and there's a target. We know what happens to the target stock price. What happens on the... It jumps 15, 20, 25%. So if you're a target company stockholder, you're doing the happy dance. You know what on average acquiring company stock prices do on the day of the acquisition? They go down. They go down about 1.5%. So only 1.5%. That's still a good trade-off. You know why it's not? If big companies take over smaller companies, a 20% jump in the small company and the 1.5% drop in your value as a company might actually wash out. So on the acquisition day, here's what the market seems to be saying. On average, companies pay too much. You know what managerial responses to that is? They don't get to see what we do. And that's technically true, right? They don't get to see the projections, the synergy, all the neat stuff. So here's what I'm going to leave you with. An acquisition's been announced. You can look at the market to see what the market thinks and use that as it. Or you can listen to managers tell you whether this acquisition is a good acquisition. As I said, about 55% of all acquisitions, the stock price of the acquiring company goes down. So according to the market, more than half of all acquisitions are overpaid for. If you listen to managers, 100% of the acquisitions are good acquisitions. One of these two groups has to be right? So if you follow up 5 years after, 10 years after a merger, you know what the evidence suggests? In 83% of all mergers, there is no synergy. In fact, there's often reverse synergy or at best zero synergy. A lot of mergers don't work. And one of the best predictors for whether an acquisition will work is actually what happens on the acquisition date in the market. We dump on markets all the time, talking about how short-term they are. It's amazing how markets can often do a much better job than experts can, or managers can, in assessing whether an acquisition is going to work. So next session when we start off, we're going to start off with a couple of big acquisition examples so you can see value destruction in play. And think about why is it that managers keep going after these big deals.
Question about
along the way, it's supposed to be the lead section, and when you get the government, you read the section, you read considering the structure, why do some of the companies go, why does my company go wrong? So my suggestion is that you really look at a company that would have issues and needs that company that section and why they go. But that's where the richness of the company is. Because it's all very different to those companies, not just one. Hi, how are you?
I'm good. How are you?
Good.
So, this is the second finance class I've ever taken. So, for some of the terminologies, sometimes I have trouble following. What do you recommend?
Read the book ahead of time.
Read
the book ahead of time.
Oh,
You took what's the first class you took? Foundations?
Yeah, foundations.
What term have you used so far that you haven't heard before?
I think in foundations, most of the stuff we talk about like the basic principles and.
But what terms have we used in this class that you haven't heard before?
I think it's more like when you talk about acquisitions and like
That comes from reading the news. I think that you're not going to get that in a class. That just comes from reading the business news and being aware of what's going on.
Okay.
So one thing you might want to start doing is read the Wall Street Journal every day. Read the business news, because without it, you're going to get unmoored. There's no class that'll let you get caught up on things like what's an acquisition, So basically, that's the only way to be on top. So do the readings for the class. Do as much as you can of the outside readings, because that'll kind of bring you up to date.
Okay. Thank
Okay. Hey, how are you?
How's it going?
Good.
Spiros, by the way.
How's it?
Quick question. So,
I'm sorry?
Can I just
Yeah,
sneak
absolutely.
in?
Go ahead.
Thank you.
There should be two packages, syllabus and a project. Yeah.
are you